Welcome once again to another video. Right now I want to review and add some new information that relates to option spreads and combinations. Okay, so since you've already spent a lot of time studying options, let me do this rather quickly, but hopefully not too quickly. Okay, so let's start off. You'll remember the spreadsheet. On this spreadsheet, this area right here where I'm moving the cursor will show the net total diagram, profit diagram, and you'll see the net total as well as the profit diagrams for the constituents of the specific spread or combination we're using. So you'll see, like for example, if we have a call bull spread, you'll see over here the profit diagram for the long call and for the short call and for the combination of both of them. Okay, so let's get started. Some basic review. Let's say I go long 1, call 2. There is the profit diagram. Here we're showing a cost of 108 to buy it. Let me turn off the commissions, because there's no reason for us to have those in there now. So we'll assume 0 commissions, and by the way, there are plenty of places on the web where you can trade at 0 commission now. And so 1, call 2, pay the ask price 108, therefore your maximum loss is 108. We'll note that the time until expiration on this is right here, and that's our proxy for 0. If I put a 0 in there, we have a problem because in the Black-Scholes option pricing model, specifically for the value of D1 and D2, the denominator becomes 0, and of course that's an undefined value, so we have to use a proxy for 0. Here I have 1 e to the minus 10, which is start with your 1 and then move the decimal places 10 places, move the decimal point rather 10 places to the left. So it's very, very close to 0. Time to expiration. Risk-free rate is assumed to be 2% in continuously compounded form. Standard deviation, expected volatility, implied volatility, whatever you want to call it. Really high, 0.38, just because. And stock price assumption at the end of the period is 31.24. Again, remember, with this spreadsheet, we take some position when the values of the options, calls, and puts are indicated here, and then we are graphing our profit at some point in the future where the remaining time to expiration is shown here. This is our proxy for at expiration, and the data that I got is real data, and the option lives were 2 weeks. So these were values 2 weeks before expiration. So you couldn't put a time to expiration value in here of 3 weeks or 350 seconds. Remember, the Black-Scholes option pricing model wants time to expiration measured in years. Okay, so 3 weeks would be 350 seconds of a year. So it has to be a value less than 250 seconds. And here we have again our proxy for option expiration. And there's a long call. Since it's the time to expiration is assumed to be at expiration a moment or two before, we have a bend, and the bend, as is always the case when we have option expiration profit diagrams, bends occur at strike prices. So our strike price for this option is obviously 31, and it's call 2, and call 2 has a strike price of 31. You can see that up here. You've had a lot of instruction on this spreadsheet, so I'm just assuming you remember that. If not, you have to go review some of the earlier videos in my Groovy Options playlist. All right, so here we go. So there's one break even, obviously. Here's the horizontal axis. So it's not at that dot, but it's pretty close to that dot. One break even. It makes sense because in order for you to make money on this, you're buying the right to pay $31 a share. So it just makes sense that for you to win, if you hold it to expiration, the stock price has to allow you to recoup your initial investment. At expiration of the option, all you have left is intrinsic value, and so that means you need the stock price to be enough to cause the option value to allow you to recoup $108, On a per share basis, since the option contract multiplier is 100, this cost of 108 becomes 1.08. So our break even is going to be right around, well, it's going to be exactly 32.08. You can see here at 32 that we lose the $8 and minus 7,999. And so the break even would be at 32.08. And that's the case. So when we have a long call, we have one break even. Okay? If not surprisingly, when we have a just a long put, okay, this one's costing us 135. So here we see our maximum loss is 135, and of course we have one break even. We've got to recoup the 135 as of option expiration, and since the strike price of put 3 is 32, and we have to recoup $1.35, it's going to be somewhere, south of 32, excuse me, of 31. So we got to recoup $1.35 below 32, so 30.65 looks like about, because at a price of 31 we're still losing $35. At a price of 30.50 we're making $15. So 30.65 will be our break even there, obviously. Okay, so the long put, one break even, no surprise there. And we'd buy a put if we were bearish, we'd buy a call if we were bullish. What if we're neutral on a stock? Well, if we're neutral on a stock, neutral means we don't think the price is going to move up or down a lot, then we might write a call. So let's say the stock price is 31.24. I might choose to write call 3. So take a short position and call 3, and then there's my profit diagram. And we see that, again, we have one break even. Interestingly, when we write calls, also true with puts, but current circumstance, when we write calls, the call can expire in the money and we still make money, okay? So here we received $56 when we wrote a call with a strike price of 32, and we see even at a price of 32.50, we're still making $6. The implication is the break even is 32.56, which makes sense because we received $56 when we wrote it, and the multiplier for the option is 100, so 56 cents on a per share basis is what we have to make up. So there's a break even here, excuse me, at 32.56. So one break even for the short call. I can also write a put, and let's see how that might work. If I wrote put 2, okay, so let's assume I expect the stock price to be at 31.24, and I write put 2, that's got a strike price of 31. When I write it, I receive $84. And if stock price is at 31.24 at option expiration, then I'm going to do just fine. And here I'll put 31.24. Then I make my profit. You can see down here of $84. Okay, so and the break even, of course, will be at a price for this short put a little lower than 31. You can see here, looking at this little marker, at 30 I'm losing $16. So at a price of 30.16 I'd be breaking even, and that just makes sense, okay, because the strike price of the put's 31. Okay, now let's look at a short straddle. I'm a short put 2, I'll go short call 2. Okay, and you can see here's the net total profit diagram. That's also over here, but here on this olive green line we see the profit diagram for the short call, and here this somewhat lighter blue line we see the profit diagram for a short put, and then this slightly darker blue line we see is the net total, which is replicated over here. And very interesting. So a neat thing about writing a straddle is that you have, if the stock price were to close exactly at the strike price, remember these options have the same strike price, 31. If the stock price closed at 31, it would be great for you as the writer of the call and the put with that strike price, because both of those options would expire worthless, and you get to keep both of the premiums, both of the cash flows you received when you wrote them, 107 for the call, 84 for the put, and 191 bucks, and therefore your profit would be $191, which would be a wonderful thing, I guess. But the neat thing about short straddles is the stock price can be below that strike price or above that strike price by, in this case, $1.91 a share, and you'd still either break even or make money. And that's a kind of a cool thing. So notice for the short straddle there are two break-evens, and they are the strike price of the options plus or minus the sum of the cash flows received when you wrote the call and the put. Okay, so spend some time looking at that and thinking about that. And you'd enter this trade when you were neutral on something, on the underlying stock. Now let's just turn this into a long straddle. Okay, long straddles are kind of interesting in that you would set one up if you didn't know whether the stock was going to go up or down, but you thought it was going to move one way a lot. A good example of this would be just prior to a biotech firm announcing the results of a trial, and maybe even more precisely, when the FDA announces whether it will grant the firm a license to promote and distribute the drug. So suppose that announcement date's coming, and if the drug passes, it's thought the price will rise a lot, the price of the underlying stock. If the FDA denies the firm the right to market and distribute their drug, then the price will fall a lot. And if you don't know what's going to happen, then you might set this up. But one thing you have to remember is when you go long both a call and a put, you're paying two premiums. So here you're paying 193 bucks. And that means relative to the strike price, which in this case is 31, stock price has to move either up either up $1.93 a share or down $1.93 a share before you even break even. So you need a big move. And what's interesting about this, what's ironic, is that when this trade is, quote, called for, end quote, as in my prior biotech example, everybody knows the uncertainty is high, so implied volatility will be very high. And as you understand from your option trading, that means the price of the call and the price of the put will both be very high. So that means you have to pay more for both of them, which means the price has to move even more up or down for you to recoup your initial investment. So keep that in mind. Long straddles, you might want to think about them for a while before you put one on. Alrighty, so let's, and then I'll just show you if you're, let's go back to being short put two, one contract, and instead of being short call two or long call two, let's be short call three. Okay, and that gives us this net total profit diagram. Here you see it repeated over here. Here is the short call with the lower, here's the short put with the lower strike price. Here's the short calls profit diagram with the higher strike price, and you can kind of piece them together and add vertically this and this to get the value of the net total. Don't ignore those little dips. That's an artifact of the charting algorithm in Excel. So that's a straight line as is shown over here. So we get this where we get a flat line area. So it's a little different from the straddle, short straddle, in that you kind of lose the little triangular area up there. And I guess we're left with, what's that, trapezoid profit area there. and a whole lot of negative down here. So with this, and this is called a strangle, this is a short strangle. With the short strangle, again, we have two break-evens. Okay, we get to keep, relative to the relative to the lower strike and the higher strike. Okay, we get, we're allowed movement in the amount of the total, which is $1.40, either way before we start losing money. So it's very helpful for us. The lower strike in this one is 2, which is 31. And you can see that $1.40 from 31 leaves us at 29.60. So here at 29.50, we're losing 10 bucks. At 29.60, we'd be breaking even. And think through the same thing on the upside here for your own, to show yourself that you understand what's going on there too. So again, with a short strangle, there are 2 break-even points. Unlimited risk here, large but limited risk here. Okay. Very good. Let's, if this risk bothers you and this risk bothers you, as you remember, we can turn this trade into a condor, and I can, since this is going down with a slope of minus 100, I need to make it flatten out if I want to limit my risk. So I need something that at these stock prices over here is going up at the same rate, indicated by a slope of plus 100. So I might buy call 4. And if I do that, then I have this profit diagram. That's comfortable. Now I have no, looks like I don't lose money on the upside no matter what. Still have a big loss on the downside, but the price I pay is my maximum profit fell. Of course, I got rid of some risk, and the price I have to pay for that is a lower maximum profit. How much lower? Well, by the amount I had to pay, $27, to buy this call. If this part makes you nervous down here, then you're going to think about controlling your risk on the short put 2. That would be controlled by buying put 1. And then we'd be left with this. And this thing is what is known as a condor. Okay? A condor. I won't use the word short or long. It's confusing. In this case, we have a short iron condor or a long condor. Don't worry about that right now. Okay, and here we have 2 break-evens, obviously right here and right here. 4 relevant strike prices. 1, 2, 3, 4. And of course, since we're looking at this profit diagram as of option expiration, then we have bends. Well, let me just show you here. What if I make the time until expiration equal to 1 week, 1/52 of a year? Then we get that shape. Okay. Interesting over here also. You can see the 4 options that comprise or constitute the condor and their profit diagrams, and the profit diagram for the net, I call it the net total, which is shown here. And of course you see an awful lot of curvature. Okay, again, we go back to time to expiration being, there we go, and then we see the bends. Okay, short condor, long condor, which is everything would be long. And so, straddles and strangles and this condor, those are several combinations. Let's look at one more. Butterflies. And a butterfly, probably best understood. Let's assume we start with a short straddle, or short call 2 and short put 2. Okay, and then we get nervous about this large but limited loss and this potentially unlimited loss if stock price takes a moonshot toward infinity. And so we can, we can limit our risk on the downside, both for stock price decreases and stock price increases. In this case, we'd buy call 3, and we'd also buy put 1. And then we get this, and this is known as a butterfly. Because this is made of calls and puts, this is a short iron butterfly, or also referred to, if we create it from either all calls or all puts, and we can do that, a long butterfly, just referring to the profit diagram. And just here, if you stare at this picture for a second, just to show you that I can create this by using just, I'll use just calls. Now notice this is a short iron butterfly, and the net cash flow at position initiation is plus 82, and so we use the word short, because when you open with a short position, you have cash coming in. But I can replicate that with just calls here. I'll show you. Just remember the diagram you saw up there. So I'll go short. Okay, so I'll go short 2, call 3s, long 1, call 2, and long 1, call 4. And there's the same diagram, okay? But notice that the cash flow associated with setting this up is negative. So that's why when you do them with either all calls or all puts, this would be called a long butterfly. The word iron disappears because it's just made of calls, some long, some short, but only calls. And this is referred to as a long butterfly. Kind of goes against your initial thought, because when you stare at this, you think short straddle, but that's the way it is. It's based upon the sign on the cash flow when you open the position. Okay, now that's enough on combinations. Let's look at spreads, okay? If I'm long 1 contract of call 2, there's my profit diagram. I can reduce the cost of that. That's going to cost me $108. If I don't think the stock price is going to go below, above exercise price 3, which is 32, maybe I'll write call 3. And when I do that, I get this profit diagram here. This segment right here is not vertical. It has a positive slope. You can kind of see it better over here. Okay? And again, when you tear it apart, the green line is showing me the long call with the lower strike. And I guess that's a violet line, or yeah, violet line, is the profit diagram for the short call that has the higher strike. And this blue line in between is the net total, which is graphed by itself over here. Excuse me. And that's a call bull spread. And call bull spread has how many break-evens? 1. How many relevant strike prices? 2. And that's the call bull spread. Call bull spread is a net debit spread. I could create this same profit diagram using puts. Let me show you that, 2 and 3. Oops, backwards, sorry. There you go, same profit diagram. And of course, you'll notice that when I used puts to create that, I have a positive cash flow here. So I start off with a positive cash flow, and that's a put bull spread. Put bull spreads are net credit spreads, and we just saw that call bull spreads are net debit spreads. Okay, and the maximum value of this spread, I'll go back to the calls. Students generally have an easier time, at least early on, working with calls. So go back to the call bull spread. And the maximum value, not profit value, the maximum value of this position at option expiration is $100. It's the difference in the strike prices. 3.2 is 32 minus 3101 times 100. So $100. The difference in strike prices is the maximum value at option expiration. So the maximum value for this thing is $100. And it'll be worth $100 if the stock price at option expiration is at 32 or higher. Okay? At 32 or higher, as explained in earlier option videos. The lowest value, not profit, but value is 0, and that will be the case if the stock price at option expiration is 31 or lower. And if it's worth nothing and we spent 52 bucks, then we're not surprised that we lose 52 bucks if the stock price is 31 or lower at option expiration. And so we cap our profit and our loss. And of course, this distance from here to here vertically is 100. Because remember, profit is value minus cost. So the maximum value is 100. And if it ends up that the stock price at option expiration is 32 or greater, then since we spent 52 bucks, we're going to make, as you can see there, $48 in profit. Whether the stock price is 32, 33, or 576, we're going to make the profit of 100. So the maximum value for a call bull spread at option expiration is the difference in the strike prices multiplied by 100 here, $100. Okay, and these spreads are very comfortable and popular option positions. Now this is a vertical spread, which means the options have the same expiration date but different strike prices. There also are horizontal spreads. That would be when the options have the same strike price. The long and the short options have the same strike price but different expiration dates. And there's a diagonal spread that you'll hear about where the options have both different expiration dates and different strike prices. But we're going to focus on vertical spreads. I would imagine vertical spreads are incredibly common. Calendar spreads or horizontal spreads or time spreads, they're all synonymous, are also very popular. In case you're curious, you might say, why would someone say write a 32 strike call expiring in January and buy a 32 strike call expiring in February? And the answer has to do with the fact that the rate of time decay differs for those two options. And you would take that position on when you thought the rate of time decay on your short call would provide you a bigger benefit than the rate of time decay on your long call would provide you with a detriment. But again, here we're just going to focus on vertical spreads. Okay, so I'm about done with this video, and we're about to turn to a very interesting application of a series of vertical spreads and some neat trading advice that comes from that. Thanks for watching.